Welcome to the Energy Policy Seminar. I am Henry Lee. I'm the Director of the Environment and Natural Resource Program at the Belfer Center, and one of the sponsors of this seminar, along with the Mosaba Rahmani Center for Business and Government and the Harvard University Center for the Environment. Let me remind you about some of the logistics. We are recording this seminar and we'll post it on the seminar series website. So if you have a friend or colleague who misses the talk, please let them know that they can watch it here. And we have registration links for the remaining seminars for this semester. We will take questions through the Q&A function in Zoom, and please click on Q&A at the bottom of your screen and submit your questions. Today's talk is on the implications for the oil and gas industry during the energy transition, and our speaker is Don Paul. I think this is a very timely talk. Oil prices have surged above $100. There are looming shortages in both Europe and in Asia. President Biden's decision to increase U.S. production and shipment of LNG to the EU has triggered significant amount of debate, and the debate sort of epitomizes the tension between the need to reduce carbon emissions and meet the and on the other side to meet our energy security goals. So carbon reduction and energy security seem to be at loggerheads, and the one big question is, what is the role of the oil and gas industry in the era that is now unfolding? Our speaker today is Don Paul. He is the William Keck Professor of Energy Resources at the University of Southern California and is the Executive Director of the university's Energy Institute. Prior to going to the University of Southern California, he had a 33-year career at Chevron, retiring as Vice President and Chief Technology Officer. During his time at Chevron, he had responsibility for a wide range of Chevron's operations, including cyber and their Canadian operations. He is now also the senior advisor for the Center for Strategic and International Studies in Washington, and he holds multiple degrees from MIT. Don?
Well, thank you very much, Henry. Let me bring up my slides. It's good to be with everybody today. I was looking forward to this this event. Let me get up to full screen. Okay. Well, as Henry pointed out, energy transition is kind of the driver of the day across all segments of the energy business. I think that I want to point out today a couple of key things with respect to the oil and gas segment of this and the roles they may play as time goes on, but can't cover everything to cover my semester graduate class in this subject, but try to provide you with maybe some provocative ideas and really look forward to your questions at the end. So let's get started. I think the best place to start is to look at the history of energy transitions. We'll do this briefly. Here is data showing total primary consumption. This is all energy sources. Going back to note the dates, 1800, so essentially at the very beginnings of the Industrial Revolution. And a couple of interesting observations from this. One, as you see on the right, which is really kind of where we are today, we're still in a system dominated by fossil energy, oil, gas, oil, and coal. And that's likely to be the case for quite a while. But some people might even argue that, well, where's the transition? But actually, I would argue there definitely is a transition, and it's reasonable to expect transitions to start slowly because they always have. But I think it's useful to kind of look at a couple of points here. If you think about the real onset of coal, now the Industrial Revolution had been underway for a while, and the energy sources were primarily biomass, woods. But coal, when coal came on, coal provided a significant new source of fuel to produce steam to run factories of the Industrial Revolution, and continued to grow. But one of the interesting observations is that even though, as you can see, coal continued to grow, biomass really didn't go away. And that's an important point. I'll come back to it in a minute. As you move on, of course, into the 20th century and the onset of mass production, in particular mass automobility. And it simply wouldn't have existed without the growth, significant growth in oil production, particularly in the United States. Now, oil had been around for a while, but not at the volumes that matter. So it was really the major discoveries and growth in production in the early part of the 20th century in Southern California, soon to be added by Texas and Oklahoma. And all of a sudden, from then on, really basically to 1970, the US had a significant surplus of oil production. So oil could be used all of a sudden for things that didn't really exist, such as mass automobile transport. But notice again that even though when oil started, coal didn't go down, flattened a little bit for a little while, because oil could be used for power, but it didn't go away. Biomass didn't go away. So you see the theme here is in past energy transitions, as you brought on a major new source, the old ones didn't go away. You really built on what was produced before. And of course, natural gas, nuclear really entered the scene in some volume in the 50s and created a significant growth potential for the electrical infrastructure. Now, here we are. I'm kind of designating the real beginning of the energy transition as somewhere around 2000. You could argue that, you know, we've been using solar before that, but my argument would be that its scale is what matters. You'll hear that term as we go on. But I would argue that if you look a little more closely, and this is the period of 1990 to today. So you're really looking at a 30-year period of time. And you can see the transition effects. If you look to the right, you see the growth in that, sharp growth in renewables, steady growth in natural gas, which is the red curve. And what you're seeing is it's displacing coal. You see coal dropping, and you see oil basically dropping dramatically. There was a time back in 1990 in which oil was a sizable portion of the electric generation energy mix, no more. And so I would argue the transition's underway. And if you want to see a more specific example of it, I point to my home state of California. And what you see here, this is from the California Energy Commission, is the in-state electric generation. This goes back to 2000. And we were starting to see what I would call sizable, by no means dominant, but sizable installations of wind power. And you really see things take off from a renewable perspective about 2010 as solar began to embed itself in the electrical system. And today, wind and solar thermal, approaching 25% of generation, and displacing, you see the drop in nuclear. Gas has dropped off a little bit, but has basically stayed steady. But this is kind of a picture, and I'll refer to a couple other things about California, because I think given the policy structure, the energy system in California in some ways might be viewed as a reflection of the energy transition, the early part of the energy transition. So what are the drivers historically? You can look at them here. I'm not going to discuss all of them, but a couple of key things. There was certainly the ability to deploy a new source, not just deploy it, but deploy it at scale that makes a difference. And I keep mentioning scale. I'll mention it again. It is the key characteristics of the energy system. And if you're going to have a transition, you need to transition at scale. And that's why I personally believe that the transition of oil and gas, which itself accounts for almost 60% of the world's total energy use, its transition is going to affect the overall transition. Obviously, new markets have historically affected energy transition. Automobiles, of course, aircraft as a part of World War II, computers and server farms today are a major source of electrical power use. And what happens with capital. But the key message, I think, if you look at the past transitions, is that all the past transitions have basically been additive. That is, they built on the existing sources, diversified them, but most importantly, provided the fuel for growth in overall demand. Now, if you look at the new energy transition, I would argue it has a different characteristic, and I think it'll be interesting to see how it plays out. Obviously, a big part of it is the societal demands for lower carbon energy sources and manifested through political actions, policies, regulations, and so forth. The availability of low carbon resources deployable at scale. Wind and solar have been around for a long time, but it's really only in the last decade plus that they've demonstrated that they can in fact scale up, which is the key issue. You can't have a successful energy technology if it doesn't scale up. And we're starting to see shifts in the flows of capital. I'll mention a little bit more about that in a minute. But what's different in my mind about this, if you look at the political ambitions, particularly with respect to displacing higher carbon supplies, is in this transition, you're trying to do two things. Both provide additional energy that certainly the global energy system is going to require. Total energy use in the world is not going to decline unless we have a very, I would argue, a catastrophic economic environment. But in addition to adding to and supplying the energy for growth, it has to substitute to replace higher carbon traditional supplies, i.e. fossil fuels. That's different. It's not just layering on what we have, it's actually beginning to displace some of the long-standing sources, particularly coal. And you saw that in one of the plots. The displacement in the United States of coal by natural gas has actually materially reduced the total carbon footprint of the United States. So this dimension of the transition, I think, has yet to be determined interesting impacts, and maybe we'll get some questions around that. This plot here, kind of for reference from the IEA, and it's very recent. It's 2019 through 2021, and it shows the kind of patterns that are taking place in different kinds of energy investment. A key point to remember is the total investment in globally in energy is about $2 trillion a year. Put that in perspective, that's about the same as the global military budgets. For example, it's about half of IT investments. If you had this plot in 2010, the green bars would be a lot lower. The purple bars to the left on upstream, for example, development in oil and gas would be much higher. Today, the expected investment in oil and gas is probably, this year it'll come up some, but it's basically going to be in the range of $700 to $800 billion. The investment in renewable power and network transmission structure and storage together will be perhaps equal to that, perhaps even a little greater. The reason I show this slide is if you look at and try to estimate the kind of capital requirements that are going to be required for the energy transition, $2 trillion is probably not enough. So that begs the question, where is the money going to come from? And that's always part of the issue with respect to energy. because those of us who work in energy tend to think that what you work on is what energy is about, but it's really about, and always has been about, a combination of things. Technology is clearly a part of it. Economics, policies, critical in energy, always has been. And then, what does society think? What do consumers want? So it's always about those things, but it's also about scale. It's about capital, and therefore it's about time. And one of the debates today, of course, is what's the time frame for the energy transition? I would argue, and I'll raise this point again, that it's not going to be even. It's going to be an uneven transition with respect to timescale. Some assets will last longer than others. Some regions will evolve differently than others. But ultimately, scale, capital, and time all fit together. If you want to shorten the time, you're going to need more capital, for example. And those are the debates that I think are going to take place, not only in governments, but are certainly taking place in industry, including oil and gas. So what are the challenges? I mentioned these, the scale of the transformation. You're talking about changing something that affects absolutely everything. And some parts of that can be changed very efficiently with little impact. We've seen that with the displacement of coal power in the US and Europe by natural gas and renewables. Capital demands, how is that going to work? Who's going to finance it? And that therefore it brings uncertainty with respect to the timeframes. But there are other issues that are really important. Supply chain, and we're seeing that play out in spades today. There's a major disruption in the oil and gas global supply chain as a result of the war in Ukraine and the subsequent embargoes of Russian oil and gas production. How is that all going to get rearranged? And I think that's yet to be determined. Perhaps we can talk some more about that with the Q&A. And then the final point, which is probably under the radar for many people, but is extremely important to the oil and gas industry, particularly in the United States. And the United States is in a unique situation with respect to the size of the legacy asset base for oil and gas. Let me just show you a couple of examples. This is a plot from the EIA, which talks about the total producing wells in the United States, which they track with pretty good data. And there's been a fall off, certainly through 2020. Part of that was due to the COVID-induced recession. But a way to think about it is roughly 1 million producing wells in the United States. And what's interesting from this plot, and I think this is something to keep in mind, all the blue, starting at the dark blue at the top, all the way to the light blue at the bottom, are all the wells which produce 15 barrels a day or less. 15 barrels a day or less. And in fact, roughly a third of those wells produce less than 1 barrel a day. So the US has a huge inventory of legacy oil and gas assets that ultimately are going to have to be handled by the industry, by government, in cooperation with government. And this is an issue that the energy transition will have to take care of. In fact, if you looked at abandoned wells, now think about that. These are abandoned wells. Now, these are estimates from different groups. The one on the right is the EPA estimate study that was done in 2020, that there are basically more than 3 million abandoned wells, not producing wells, abandoned wells. And of those, only about a third have actually been plugged. The others are sitting there. This is a huge potential environmental issue, and not just locally, but nationally, because the amount of potential methane leakage from these wells is a significant source of greenhouse gases and will need to be addressed. So where do all of these come from? Well, it's history. I'm going to show you a picture. This is a picture of downtown Los Angeles, Wilshire Boulevard. 1902. And at that time, Los Angeles was the largest producing area on Earth. In fact, by the time of World War I, California was the equivalent of OPEC in terms of production. So here's a picture, and there's a well in every yard. Why does that mean something? Well, the thing that means, and where I'm going with this, is the US oil and gas industry is unique. And it's unique because of US property laws and, most importantly, mineral ownership. The United States is the only major country, certainly, in the world, with a little bit in Canada, Western Canada. But basically in the US, private individuals and private companies own the mineral rights. And in the US today, it's 90, dominates the total mineral ownership. And that changes the structure of the business and changes the structure of how changes to the oil and gas industry are going to be affected. Just to give you an example, there are more than 12 million mineral rights, oil and gas right owners in the United States. 12 million. There are more than 600,000 just in California. So the diffusion of ownership, the decentralization of operatorship is unique to the United States. And I'll comment more about the implications of that in the transition a little bit later. This is a picture of orphans. These are ones that were wells owned by companies who went bankrupt and now are the properties of the states. And you can see the oldest wells up in the Northeast Appalachian region, to the left, California, and then of course wells that came on stream in the 20s and 30s in Oklahoma, Texas. But the point is, there are hundreds of thousands of them. And this is a significant issue because these are now on the books of the states. The other characteristic about the US that makes the discussion of the transition different is that in the United States, offshore is a different story. Offshore is basically regulated by the federal government. Onshore, almost all oil and gas production is regulated by the states. And therefore, again, you have a decentralized management of the industry. And then finally, just mention it, but we're not going to solve the CO2 problem unless you solve the coal problem. And while Europe and the United States are pretty rapidly getting out of the use of coal for power, it's growing and growing substantially in Asia. So ultimately, the displacement of coal is a critical element in any serious calculation about global CO2 reductions. So if you think about the opportunities that are coming from the transition, you're having significant capital flows. I think they will increase, and therefore there's going to be lots of opportunity in different aspects of the energy system. I think there's a material opportunity on a global scale to displace coal with natural gas. Now, people would say, well, yeah, but that doesn't solve the CO2 problem. No, but it's a good first step because it cuts the problem in half. And I personally believe that the displacement of coal by natural gas on a global scale is going to be one of the important dimensions about the energy transition. And admittedly, you still have a carbon base if you're based with natural gas, but it's significantly less than coal. The second thing about this, it's been proven to work at scale. Come back to that point. The US has done this already. Europe has done this already. That the displacement of coal with natural gas is fairly straightforward because it creates baseload power. So the overall management of the grid and the infrastructure doesn't change when you displace a coal-based boiler with a natural gas-based boiler. There obviously, this question of repurposing legacy assets is particularly an issue for the United States. It's a substantial issue in other old producing areas like Western Canada. We're seeing it in the North Sea. And of course, the other country that has a huge legacy oil and gas base is Russia. We talked about what will happen to the energy supply chains. We were talking before we began about the issue of the re-engineering of these supply chains due to geopolitical events. But ultimately, carbon reduction is going to require significant re-engineering of these supply chains. And there's going to have to be new natural resource developments, this time for the minerals, particularly lithium, rare earths, that are going to be required if you can electrify the vehicle fleet and significantly continue the growth of solar and wind. We're going to need much more mining than we currently have globally if we're going to support those ambitions at scale. So let's look at the structure of the industry and the implications, the structural impacts that the energy transition may have. It's useful to think about the industry and in its different parts, because these different parts do not have the same drivers. They don't behave the same. There are regional differences, of course. National oil companies, I think how they evolve during the transition is going to be very interesting to watch. If you look at Saudi Aramco, which is the biggest and arguably the best managed of the group, they are in fact looking for ways to diversify the uses of oil. I'm talking about eliminating production because it's such a central part of the national economy, but using it for petrochemicals, for example. It'll be interesting to see what national oil companies do, because in many cases, these state-owned enterprises are critical parts of the economies of those producing countries. And it certainly strikes me that any future which truly eliminates all fossil fuels is going to be viewed as a very challenging environment. But let's focus a little more on the parts of the industry that people think about as the oil industry. You look at the integrated global majors. So this is Chevron, Exxon, BP, Shell, Total, so on and so forth. These companies operate worldwide, although they do have a home base, and that influences, I believe, their strategies. They have both upstream, that is exploration production, but they also have midstream and downstream, that is they make products. So one could think that in the transition, these companies would be looking, and some are for sure, looking at how to diversify the products they make. So instead of just making traditional refined products such as gasoline, diesel, and jet fuel from oil, maybe there's other things like petrochemicals. Also displacing direct fossil use, but perhaps being in the electricity business like the utility. It remains to be seen, but there's some sort of interesting data. There's some work that A.D. Little does that look at capital. This is through 2018. I think these numbers have shifted some, but I think this is indicative of how much capital are these companies deploying into low carbon investments. Now, these have grown in the last 3 years, substantially in some cases. But what you see is what I would call a testing environment. Total and to some extent, I think BP have really made bigger commitments. They've started to move to really operating businesses. But many companies, particularly the US-based companies, still kind of view this as, we need to understand how we're really going to make money with this and on what scale. Which I think for the US-based companies makes sense, because by no means all, but much of their fossil fuel production still comes from the US. And one of the big differences between European multinational majors and US multinational majors is that Europe, in a sense, really with the exception of Norway, that has no oil and gas production of scale. US far, far larger. And therefore, it makes sense that a Chevron and an ExxonMobil would have a significant leg in the US production base. I do expect them to diversify over time because they have the means. They also have the experience with the downstream. That is, they have the experience producing products that are sold directly in the commercial markets. Most independent upstream producers don't do that. They actually just sell their crude into a pipeline off of those. They do not refine, make products, and eventually get into the wholesale and retail markets. So when we want to talk about the major independents, some are calling them now mini majors, and the US small and mid-sized producers. This is much a US phenomenon, although not totally. We are seeing some of these independents get into the North Sea, which is in certainly on the backside of its production peak, but may still hold sizable oil and gas reserves. But the idea that the major independents and the small mid-size are going to diversify into renewables, I just don't think is likely going to happen. They are using renewables for their own use power. We see increasingly US oil and gas operators deploying renewables, wind and solar, to reduce their carbon footprint. So in that sense, that's still a driver. And in fact, I would say that the reducing operational carbon footprints is now a universally accepted business strategy, no matter what your size is. But in this group, probably the most interesting thing that's going on, in addition to sort of consolidating assets, which gives you more scale and hopefully smaller unit costs, is the idea of diversifying their capital structures. There's a lot of debate going on about in the financial industry about do you support new oil and gas developments or not. And I think that's leading to an evolution of capital structures. And there's two aspects that I've seen in person basically occur in this industry, particularly with the mid and small sized independents, of which there are thousands in the US. And that is many more are going private. They basically take private capital, get rid of their public shares, take themselves out of the spotlight of activist ESG investors, for example, remove themselves from direct SEC regulation. And I think that's a natural fit for a lot of smaller US producers to acquire private investors who can then basically manage the businesses the way they best see fit. And I think you'll see some producers say, well, we'll take your free cash flow, you give it back to the investors, just do the best you can, produce out the assets you have, and everybody will go home in, say, 10 years, and we'll maximize our returns. The other kind of things you are seeing is increasingly a return of capital model, which is a variant of that says, we'll take our free cash flow, we'll put enough capital into the business to roughly maintain our production and give all the rest back to the investors, which is a big change from the shale boom we had a few years ago, where every dollar that you got and then some, you put back in the ground with new wells in anticipation of growth. And so I think this is an interesting dynamic that the energy transition will drive the independent business to look more like a cash return business and much less like a growth business. There will be some growth around consolidating, that you've got a land position, you can buy up a couple of little competitors around you and get a little more scale, but I don't think you'll see the great effort at growth. The majors, on the other hand, both Chevron and Exxon, have stated publicly that they're going to go grow production, particularly in places like the Permian Basin. And then, as I mentioned before, the idea of these end-of-life assets, and the independents have most of them, the vast majority of them, actually. And so what do they do with them? can you repurpose them? Can you possibly put them in a reuse these? And it turns out that in fact there's a growing interest and growing work that has been done. We're doing a lot of it at USC. It says, look, you have this land, you have these wells, you have all this competence about how to run wells on the subsurface, and you have this immense amount of pore space from depleted oil and gas reservoirs or saline aquifers that can be used to store CO2 at great volumes, or actually do subsurface energy storage at great volumes, at volumes comparable to pumped hydro. So I'm going to wrap up here and take your questions. A couple of observations. It's easy to talk about where you want to go and what your goals might be for, say, carbon neutral 2050 world, but the road is not going to be even. It's going to vary significantly by where you are in the world. It's going to vary significantly for different companies, particularly different kinds of oil companies. I see a lot of the industry, other than the big global international majors, basically focusing on getting the most economic return out of fossil assets that they have. But it's not going to be even, and the timeframes won't be consistent. And that's going to produce, I think, a different future than perhaps some people think. There will be unforeseen events. If there's any lesson to be learned about the energy industry, and it's always been true, that things roll in out of the blue and change the equation. COVID is clearly an example of one that didn't. Timer. And then now the war in the Ukraine. These are not things where they may have been on outlying scenario planning in some companies, but certainly COVID was not anticipated by anyone, and the demand destruction that occurred as a result. So unforeseen events will always happen, and this is going to make the transition uneven with surprises. It'll bring up competition, as Henry raised, between your carbon reduction ambitions and your need for electricity and fuel today. My general conclusion is, given the scale, and especially given the fact that these two events have materially impacted what's going on in the world, both from a supply chain point of view, but also from a government balance sheet point of view. Governments, especially in Europe and the United States, have consumed an enormous amount of their balance sheet capacity fighting COVID. And so there becomes the question of, where's all the capital going to come from? My general conclusion, and I'd be glad to discuss this, is that I think the transition can take longer than people think. People saying, well, now we're going to have a major transition by 2030. I think that's unlikely. But the point is, timeframes, I think, and if you look at historical timeframes, they're decades long. So the transition, I think, will take longer. I think most people in the oil and gas business recognize that the next 10 years will probably be a decisive one in terms of determining the trajectory of the industry. But for the next few years, it's certainly the anticipation of higher prices looks favorably along those who are trying to continue in the fossil energy business. It's also, the transition may take a form. And one example of that would be, say, look, if we don't get rid of coal, we have no chance to meet carbon targets. We may need to use gas for a longer period of time in order to back out coal now, because the transition from coal to gas is so straightforward. The industry is going, and this is universal, we're going to continue, I think, to put serious effort and technology changes into practice to reduce the footprints. And the most obvious thing here to get on, and I think most companies have this high on their list of activities, is eliminate the obvious greenhouse gas sources like flaring of natural gas, chasing down, eliminating fugitive methane emissions, methane, of course, being a super potent GHG. And so I think you're going to see a steady, determined effort to reduce the carbon footprint, and that's across all members of the oil and gas industry. And you can see flaring. Who are the big flarers? Russia, number one, Iraq and Iran, the US, and simply because it has so many wells and so much production. It's interesting, Saudi Arabia isn't on this list as the third top producer, along with Russia and the US, because it has relatively little gas, relatively little compared, for example, to the United States. So stopping flaring is an essential aspect of, I think, and the industry's activities. And I think we'll see a lot of progress actually be made in that over the next few years. And I expect that the oil and gas industry, particularly in the United States, is going to diversify its business models. We talked about the fact that you're going to need to have a different idea about capital sources that could come from more private companies. I believe that's a natural fit for the oil and gas business. I think the industry will have to accommodate this growing problem of what do you do with all the legacy assets. And also the industry will have an opportunity, I think, to blend into the growing renewable business in ways that make sense. The first way to make sense is to use renewable power instead of burning gas and diesel for your own operations. So I've covered a lot of material. And I'd be glad to take any questions, and thank you for your attention.
Don, thank you very much. You certainly have covered a lot of material, and you've touched on a lot of very large issues. Before I go to the Q&A from others, let me ask a sort of broad question. There is an increasing frustration among a lot of the students here and some of the faculty about what they feel is the lack of progress by the oil industry to embrace the need to accelerate our decarbonization efforts. And they see a strategy that the oil industry says, well, we're going to do it, but we're going to sell our assets to smaller companies that will not be as environmentally sensitive. And we'll try to maximize our oil and gas sales in the next 5 to 6 years, because that will allow us to have the money to basically diversify into renewables. And the more we can sell now, the faster we can go to renewables. And while that makes some sense from the perspective of the industry, it's creating a lot of sort of back push here from a lot of the students and a lot of the faculty. How would you respond to them?
Yeah, it's a great question. And I think that where I would start is it's important to realize that, people debate on, and there's a lot of forecasters as to what, when is peak demand for oil going to hit. My guess is it's probably in this next decade. But as long as the world is going to demand 100 million barrels of oil, somebody's going to produce it. And the idea that a company would say, okay, I'm going to get out of this business and let OPEC produce it, and let the national oil companies dominate the oil production market, because their view about the demands you're talking about is significantly different than the public companies might have, for example, in the United States. We're seeing this transition, though. You bring up a really good point. I would argue that Total and Shell and BP to some extent, so these are European companies, okay, which arguably operate in a different, both a different resource environment, as I pointed out, in their home countries, but a different political environment, that they would say, we got to sell our assets and start investing in this alternative. The US companies view this and say, well, that's fine, but we have 10 times the resources that you do in the United States. So that doesn't necessarily make sense. So that's what I meant by saying, I think you're going to end up with different kinds of companies. I think that the question you would ask, if you're a small, remember, you got to realize the majority of all the production in the United States, if you want to focus on the US, is by smaller companies. It's not by the big companies. So they would look at it and say, well, what's our choice? Somehow we're going to get in the solar power business? Probably not. I mean, their view is, how do we maximize the economic value of what we have, right? So I think now the big companies, I do think will ultimately grow sizable renewable portfolios, but what's the time frame? And will your shareholders say, well, that sounds great, but I'm not sure I want a utility company rate of return compared to what oil companies make. So I think all those factors play through. And I understand the frustration of a lot of students. We see that too. But the reality is that you've got the state oil companies outside the US, which aren't going to pay any attention in particular to what you're talking about, because their national survival depends on them selling oil. They can't exist without it. And then the major companies, I think, are looking to this, but they're trying to understand, if I'm going to invest a significant fraction of my capital over the next 20 years, I very much want to understand how that business is going to work out, not just symbolically, but on the balance sheet. So I think it's just it's the issue you raised before. It's the issue between the goals and ambitions and the realities of operating in the actual energy market.
Okay, let me ask a sort of a tangential question posed by an individual who used to work at one of the oil companies, and he says, oil and gas companies which have been most forward-leaning on the transition have been punished by investors. Share prices are lagging. What does this suggest on ability to stay the course and use oil and gas revenues to power the transition?
It connects directly to the last question. I think that a lot of the investments that, if we want to talk about the global majors, who are the ones that are going to do this, okay, some national oil companies could do it too, but the small companies, I would argue, are not going to do it because they don't have the resources and they don't have the time frame, okay? Because you're thinking about, how do I change my company? If you're ExxonMobil or a Chevron or a BP at Total, how am I going to change my company over 20 years to where a sizable, maybe even the majority of my energy assets are now zero carbon or low carbon renewables? And what does that do to my rate of return? This is where the investors stand up and say, well, you know, if I want to buy a utility, I'll buy a utility. I don't need you to become a utility. And I think that's the tension that you see, because the average rates of return of utilities over decades is lower than the major oil companies. And therefore, that will have much lower PDE ratios. So all of that means my stock's going to go down in value. So it's not surprising that that investors would be skeptical. And I think that what the companies are doing now is actually makes a lot of sense, having been there. I think you'd spend a significant, but still a small fraction of your investment to do as much work today as to say, what's the hydrogen business going to be? How's it going to work? Am I going to be able to make as much money doing that as I do refining crude oil? And how do I make sure that I can make as much money? And I think that's the key. How can you make sure that you earn as much money making greener renewable energy as you do making fossil-based energy?
John Holdren asked the following question. First of all, it says, great to see you again.
Say hello, John. How are you?
I guess you were involved or remember the 1997 PCAST report.
I do. Energy technology. That's what I meant, John. Yes, I do.
One of the arguments made in that report was there was a rationale for government involvement in energy technology innovation beyond basic research when large social costs or benefits are involved.
Yeah.
How do you see the respective public and private roles in energy technology innovation today?
Well, first off, I think that a lot of the money that was invested has matured. The fact that you have a clearly fully commercially viable deployment of renewable energy sources at scale is partially a result of investments that were made long ago. Now, going forward, I think there are a couple of key areas that are natural fits, and especially if we're talking about the United States, for example. I mean, one of the key questions that you have to face, and we see this in California now, okay, which is arguably, certainly for its size, as far along as farther along in the transition than most places are. But one of the problems we have is you load up more and more wind and solar into the power grid, you need much more storage of energy because you get peaks during the day, which may exceed demand, and therefore you basically effectively sell electricity at zero, if you can sell it at all. And then you should fall short at night and you've got to do something else. Right now, California imports a lot of its power to make up for baseload. So energy storage at scale is a clear example of something where the government and industry have to work together. I would argue, and one of the arguments we've been making here with the California Energy Commission, is one of the things we can do is use all the underground pore space that we have and we know about for energy storage, as well as for the opportunity, and this is the second area, to reduce the cost of carbon capture and sequestration. If you can drive down that cost, I had one of my students do a fairly extensive economic analysis of that, at least for the California market, which already has carbon pricing essentially built in. Carbon pricing and the idea of setting appropriate carbon prices is part of the role the government has too. But I think on the research side, storage at scale, I mean terawatt hours, not megawatt hours, is what you're going to need if you're going to get to 100% renewable electricity for sure. And I think that that's a clear area to cooperate. And the other one is the whole issue of carbon capture is another area. So I think there are plenty of areas for interaction and roles for government and industry to cooperate in the transition. And I think it's going to be essential that you have an effective program to do that.
We only have a few minutes, but let me ask about one technology that several people have raised, hydrogen, and particularly green hydrogen. Do you see this as something that will emerge significantly in the next decade?
Yeah, well, we did with the Department of Energy a major demonstration of hydrogen fueling systems in the 2000s. And obviously things have improved, but hydrogen still suffers fundamentally in comparison to gasoline, for example, in two ways, which need to be overcome. One is it's much more expensive to store in volume than gasoline. The reason gasoline stations are everywhere, and the reason even the smallest little town in the West has a gas station, is it costs almost nothing to store gasoline at great volume. Gasoline is very easy to move. Hydrogen can be done. I mean, we move it around refineries today. But the idea of a large scale hydrogen gas infrastructure for transporting and storing hydrogen is still quite a ways off. And I think that's a crucial issue that needs to be overcome. Does it work as a fuel? Sure. Can fuel cells based cars work? Sure. I think technically those things are there. I think the infrastructure issue for hydrogen is the challenge.
I think my last question is sort of timely. What do you think the Ukraine crisis will mean to the oil and gas business in the long run?
That's a simple question. Well, it's what we were talking about before. I think there's several dimensions and questions you have to answer. is this, as some pundits have claimed now, this is the end of the globalized economy. In other words, we go back to a Cold War structure with divided world, with internalized supply chains and all of that. If that happens, that will have a material effect. Much of what has been done in the industry has been built around a globalized model, and it's worked great for oil, and it was on its way to working for LNG. I think most people still believe that LNG is going to be a worldwide market and going to continue to evolve. But I think in the short run, I think it may drive investment to areas of the world, oil and gas investment areas of the world in which political stability becomes a much higher parameter in terms of the assessment of risk for oil and gas projects.
Well, we've been doing these seminars for a long time, and this is the first time that we have had more than 20 questions. So I have done a very poor job of getting all of them to you, but that I think indicates how stimulating your talk has been. You have really catalyzed a lot of people thinking about these issues, and so I want to thank you very much for agreeing to do this. And hopefully,
Henry, it's been great to work with you again for all these years. And John, it was good that you were on. Good to hear from you. And on the questions, I will be, if you want to forward those questions to me, I'll be glad to get back to the individual questioners if they would like.
Okay.
With my thoughts, I'll be glad to do that. And I appreciate everybody's attention. I have to say, I've been in this business 50 years. This is the most interesting time it's ever been, because there's so much going on, and so much is going to change. But that's why I tell my students, this is the best time to be in the energy business.
Well, for those of us who are about the same age as you, we stay in this because it's so exciting. So again, thank you so much. And hopefully next time we can get you in person here.
Yes, I look forward to that.
And just want to announce that next Monday, we will have a session on space-based solar geoengineering and astropolitics with Pete Warden of the Breakthrough Starshot and Oliver Morton of The Economist. And then on April 11th, Dr. Destiny Knock from Carnegie Mellon will be our speaker. So we'll see you next Monday. Thank you all for coming, and have a good week.
Goodbye.